Candle range theory is a powerful trading model. However, some traders make it complicated and confusing when it comes to actual trading. So in this video, we'll simplify the CRT trading model, explain the reasoning behind it, show you how to spot it correctly on the chart, and reveal the best CRT trading strategy. So guys, if that's something you're interested in, smash the like button to show your support, and let's get started. So, what exactly is the candle range theory? Candle range theory, or CRT, is a trading concept that focuses on the price range, high to low, of a single candlestick on the chart. The general idea behind this model is that each candle represents a trading range. If you break this candle down into lower time frame candles, you'll notice that the high and low of the candle often act as turning points on the lower time frame. These points form the most important liquidity levels, the highest and lowest price traded during the previous trading period. This period can be a day, a week, or even a 1-minute candlestick. So let me show you how combining this single candle structure with smart money concepts can offer high probability trading opportunities. The typical concept of this strategy usually involves 3 candles, and each candle has its own important role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break this down step by step as a concept. Starting with the first candle, the candle range theory suggests that every candle's high and low act as the most important liquidity levels that the following candles will use as targets. The reason is that if you break this candle down into lower time frame candles, you'll notice that the high and low of the candle often act as turning points on the lower time frame. For the daily candlestick, these turning points are the highest and lowest traded price during that day, which emphasizes the importance of these prices. So, without analyzing the lower time frames, we can identify where important liquidity levels are just by observing a single candlestick. The upper liquidity level is called the candle range high, CRH, and the lower liquidity level is called the candle range low, CRL. We can use any candle that appears on a chart, and this applies to any time frame as well. However, certain criteria help us define what makes a candle ideal to use, which we'll be covering later in the video. Now, if the second candle attacks the liquidity above the candle range high and immediately reverses, there's a high probability that the next target will be the liquidity below the candle range low. In other words, this liquidity sweep from the CRH suggests that the market is likely to shift direction and seek out liquidity resting at the opposite end of the range. If instead we see the second candle close above the CRH, then the potential candle range theory setup becomes invalid. This is because it's more likely that the market will continue pushing upward, rather than targeting the low of the first candle's range. However, if the criteria are met and the second candle fails to close above the candle range high, we can then look to the third candle for a potential short setup with our target being the candle range low. Now, that was just the general idea and reasoning behind candle range theory. Let's move on to the actual rules and break down how to trade it step by step on the chart. Now, the first question is, which candle should you choose to apply the candle range theory? If you've studied this topic, you'll know that one of the most popular approaches among traders is to focus on the 1-hour candle just before the New York session opens. Why? Because the New York session is known for its strong reversal movements, especially right after the open. Typically, it starts by sweeping the liquidity built up during the London session, and then, often, reverses direction. This makes it a great trading opportunity. So, here's a smart approach. Apply the CRT model to the 1-hour candle before the New York Open. If the price sweeps liquidity beyond that candle's range and then returns back inside it, you're witnessing a setup that aligns both with CRT principles and the natural behavior of the New York session. This confluence can provide high probability trade setups, especially if you're timing your entries correctly and managing risk with precision. However, there is only one problem with this approach. We are trading against the trend. Trading alongside the trend gives us more confidence and better high-probability setups. So, is there any way to use CRT while following the market direction? The answer is yes. We have developed a trading setup that works with the trend and still follows the CRT idea. Let me show you how it works. First, we want to see a market that is clearly trending up or down. Then we wait for a correction, because that gives us a better price to enter and a safe place to put our stop loss. Let's say the latest impulsive move started from this point and went all the way up to here. We expect the correction to happen inside this range. From here, we start using the CRT model, but only on bearish candles, since the market is in an uptrend. We mark the high and low of each bearish candle, and then watch how the next candle reacts. If the next candle breaks below and closes under the range, the setup is invalid and we don't take a trade. Then we move to the next bearish candle and do the same. This continues until we see a candle that sweeps below the low, but then closes back inside the range. That's when we have a valid setup. We now have both the range and the sweep. Now the question is, where do we enter? One simple way is to open a buy position right after the sweep candle closes. But there's a better and more optimized way. We can zoom into a lower time frame to find a more accurate entry. For example, if we are on the 1-hour chart, we can go down to the 5-minute or 15-minute chart. On the lower time frame, we can see more details. In this strategy, we use the fair value gaps that appear after the sweep as our entry zone. So all we need to do is wait for a fair value gap to form, and then place our buy order at that level. We put the stop loss below the gap. For targets, we can make the trade risk-free by closing half of our position when the price reaches a 1-to-1 risk-to-reward level. That way, even if the price reverses later and hits our stop loss, we don't lose any money. For the rest of the trade, we let the profit run until the price reaches a strong level ahead. Since this is a trend continuation setup, this combination gives us a powerful and smart way to trade CRT, but this time with the direction of the market. Now, let's have